Welcome back to the channel. Today, we're diving into a crucial topic for every investor out there: how to prevent losses in the stock market. Listen, I get it, we all want those big wins. That feeling when you pick the next Tesla or Apple, it's exhilarating. But the market can be unpredictable, and even the best of us make mistakes. That's why it's so important to prioritize protecting your hard-earned money. Stick around till the end for some valuable tips that could save you thousands, if not millions, in the long run. Alright, let's talk about diversification. You know the old saying, don't put all your eggs in one basket? Well, it holds true in the stock market, maybe even more so. Think about it. If you invest all your money in a single stock, no matter how promising it seems, and it tanks, you're out of luck. You're left holding the bag, and it's not a good look. Diversification is like having a safety net for your investments. It's about spreading your risk across different asset classes, sectors, and even geographies. This doesn't mean investing in random companies you know nothing about. It's about strategic allocation. Think about it like this. You wouldn't build a house with just one type of material, right? You'd want a strong foundation, sturdy walls, and a reliable roof. Same goes for your portfolio. You want a mix of stocks, bonds, real estate, maybe even some alternative investments like precious metals or crypto. Now, within those asset classes, you diversify even further. In stocks, you invest in different sectors: technology, healthcare, consumer goods, you name it. This way, if one sector takes a hit, the others can help cushion the blow. And don't forget about geography. The US market is great, but there's a whole world of opportunities out there. Emerging markets, developed markets, diversifying geographically can open you up to new growth potential. Remember, diversification is not about eliminating risk entirely, it's about minimizing it. It's about creating a portfolio that can weather the inevitable ups and downs of the market. Let's face it, nobody likes to lose money. It's painful, especially when it's your hard-earned savings on the line. But what if I told you there's a tool that can act like a safety net for your investments, automatically limiting your losses? That's where stop-loss orders come in. Imagine this. You buy a stock at $50 per share, hoping it will go up. But the market takes a turn, and the stock starts to drop. It goes down to $45, then $40, and you're panicking. You don't want to sell at a loss, but you're afraid it might keep falling. This is where a stop-loss order would have saved the day. A stop-loss order is basically an instruction you give your broker to automatically sell a stock when it reaches a certain price, called your stop price. So, in our example, you could have set a stop-loss order at $48. Now if the stock starts to drop and hits $48, your broker will automatically sell your shares, limiting your loss to just a couple of dollars per share. No panic, no emotional decisions, just an automatic safety net. Now, it's important to remember that stop-loss orders are not foolproof. The market can move quickly, and there's always a chance that your stock might gap down below your stop price, meaning it opens the next day at a much lower price than you anticipated. But even with that risk, stop-loss orders are an invaluable tool for any investor looking to protect their downside. They take the emotion out of trading and provide a disciplined approach to managing risk. You wouldn't buy a house without inspecting it first, would you? The same principle applies to investing. Thorough research is crucial before putting your hard-earned money into any stock. Listen, I know it's tempting to jump on the latest hype train, especially when you see others making quick profits, but trust me, investing based on rumors or hot tips is a recipe for disaster. So, how do you go about doing your research? First, understand the company's business model. What do they do? How do they make money? Who are their competitors? You can find this information on the company's website, in their annual reports, or on financial news websites. Next, dive into their financials. Look at their revenue growth, profit margins, and debt levels. Are they profitable? Are they growing at a sustainable rate? Don't worry, you don't need to be a financial analyst to understand these numbers. There are plenty of resources available online that can help you make sense of financial statements. Beyond the numbers, it's crucial to understand the company's management team. Who are the people running the show? Do they have a good track record? Look for experienced leaders with a clear vision for the future. Remember, you're not just investing in a company, you're investing in the people behind it. Research takes time and effort, but it's an investment in itself. The more you know about a company, the better equipped you'll be to make informed investment decisions and avoid costly mistakes. The stock market is a marathon, not a sprint. Yet, so many investors get caught up in the short-term noise, chasing quick profits and panicking at the slightest dip. This short-term thinking is a surefire way to lose money in the market. Successful investing requires a long-term perspective, a mindset shift from trying to time the market to focusing on time in the market. Think about it. Companies like Apple or Amazon didn't become giants overnight. Their growth took years, even decades of innovation, execution, and yes, some bumps along the way. As an investor, your job is to identify these companies with strong, long-term potential and hold on to them, allowing the power of compounding to work its magic. Now, I understand that market volatility can be nerve-wracking. Seeing your portfolio value fluctuate can be emotionally draining. But remember, short-term fluctuations are normal. The market goes up, the market goes down. It's the nature of the beast. Don't let these short-term swings shake you out of your investments. Instead, focus on the bigger picture. If you've done your research and believe in the long-term prospects of your investments, then stay the course. Ride out the volatility, knowing that over the long term, the market tends to reward those who are patient and disciplined. We've all been there. The market takes a dip and fear starts creeping in. You see your portfolio value shrinking and your mind races with worst-case scenarios. Suddenly that stock you were so confident in seems like a ticking time bomb. On the flip side, when the market's on a tear, greed takes over. Everyone's making money and you don't want to miss out. You start chasing the latest hot stocks, throwing caution to the wind. The problem is, our emotions, while powerful, are often terrible investment advisors. Fear and greed can cloud our judgment, leading to impulsive decisions that can cost us dearly in the long run. So how do we keep our emotions in check? How do we avoid becoming our own worst enemies? First, it's crucial to have a plan and stick to it. Before making any investment, determine your investment goals, risk tolerance, and time horizon. This plan will act as your roadmap, guiding your decisions even when the market gets turbulent. Second, diversify your portfolio. As we discussed earlier, diversification helps mitigate risk, reducing the impact of any single investment on your overall portfolio. This can help you stay calm during market swings, knowing that even if one investment is down, others might be doing well. Third, avoid checking your portfolio obsessively. Constantly monitoring your investments can amplify your emotional responses to market fluctuations. Remember, investing is a long game. Set it and forget it, checking in periodically to make sure your investments are still aligned with your goals. Finally, don't be afraid to seek professional advice. If you're struggling to manage your emotions or feel overwhelmed by the market, consider talking to a financial advisor. A good advisor can provide objective guidance, helping you stay on track and make rational decisions. Thanks for watching. If you found these tips helpful, make sure to hit the like button and subscribe for more investing advice. Leave a comment below with your own strategies for preventing losses in the stock market. See you in the next video.